such a beautiful room from Smiles to see our event today. Key trends informing investment decisions in 2023 and beyond. Thank you to our presidents from the American Chamber of Commerce, the Australian Chamber of Commerce, the French Chamber of Commerce, the Chinese Business Chamber, the EDB. Great support from the community. Thank you very much for being here today, guys. Thank you also to the media for your support here today, and especially thank you to our speakers. We look forward to your valuable insights. So protocols out the way. Guys, please may I ask if we can all switch our phones on silent. We are recording the event, which Sanlam's going to broadcast to its guests later on. So please can I just ask if everyone can put their phones on silent. So the format for today will be a panel discussion. What we'll do is each of us will have a 10-minute introduction to our initial insights. Thereafter, we'll open up for questions and answers, and we welcome the audience to please raise your hand and ask questions and really get the debate and discussion going. So now for today, I would like to especially thank Sanlam for your valued sponsorship and as a key strategic partner of the Chamber. We really welcome your support. And I'll now hand over to my good friend Mark Muller, who's the Director of Sanlam Private Wealth, to share a bit about Sanlam's operations in Mauritius, Africa, and around the world, and also to introduce the speakers and the topic, and then we'll kick off with the proceedings for today. Welcome, Mark.
Thanks, Bilal. Good morning, everybody. It's wonderful for Sanlam to continue our collaboration with the Chamber. I think it's been a few years, even before you were around, when Richard was still young and handsome, which was many years ago. So it's been fantastic. So it's been wonderful for us to be part of this, and the turnout this morning, I think, has been fantastic. So thank you for all of you for coming. As Bilal mentioned, I'm just going to say a few words about our Sanlam business. On the island at the moment, we've got a number of aspects to the group that we brought here. We've got the private wealth business, which I look after. Sitting in front here is Gail Duchesne, who's the MD of the trust and fiduciary business. And then I did see Didier here earlier. Didier is in charge of there you go. Didier looks after the general insurance business. So wonderful to have a big presence of Sanlam on the island. So Bilal, you've asked me to introduce the speakers, and I had to download a few things here, particularly for Dr. Sitinen, so I'm going to do a short version, otherwise we're going to be here until 10:30 today. So, Dr. Sitinen, it certainly is a wonderful privilege to have you here and join the panel. I look forward to hearing your views. Dr. Sitinen is recognized for his role in establishing Mauritius as an international financial center when he was Minister of Finance of Mauritius from 1991 to 1995. He was also Deputy Prime Minister and Minister of Finance, Economic Development and Economic Empowerment between 2005 and 2010. Dr. Sitinen is the present chairman of the Rwanda Development Board and advises the government of Rwanda on taxes, competitiveness and financial services issues. I'm going to move straight on to Peter, who's sitting to Dr. Sitinen's right. Peter and I have traveled Africa a lot. We're trying to remember how many countries we've been to, but Peter, great to have you here in Mauritius. Beat some of the places we've been to over the course of the last 18 months or so. Peter is the lead fund manager for the Sanlam Global High Quality Fund and Global Equity Segregated Mandates, with current assets under management in the strategy of $1.8 billion. Peter has over 25 years of investment experience. Peter, in his personal capacity, has also been recognized and 3 times has received the FE Alpha Manager status, as well as Outstanding Achievement Award at the City of London Wealth Management Awards, where he was commended for his passion for investment and commitment to his clients. And then, there you go, I've got Hannah. I've had to use Hannah's iPad because the page wasn't long enough. But Hannah is the Global Equity Investment Analyst. If Hannah looks familiar to any of you, that is because she is. Hannah appears regularly, and she's the face of our team, and appears on Sky and Bloomberg television regularly. So Hannah, perhaps if you can stay afterwards for autographs for anyone that's interested. Hannah was awarded Investment Week's prestigious Young Investment Woman of the Year 2018. Hannah joined Sanlam in September 2015, having attained both an honours degree and master's degree at Trinity College of Music in London. Hannah, multi-talented, wonderful to have you on the team. So Bilal, you're going to be the moderator, so over to you. The topic being, we're going to be looking back on 2022, what has happened, how have we survived, and looking forward to what you expect in 2023. So we can do that now. Thank you very much.
Thank you, Mark, and thank you very much for esteemed colleagues and panelists. I have a very easy job today. I'm going to put some macro thoughts down in 10 minutes. I'm going to leave it to the doctor to go into more detail on the macro side. Hopefully I'll have some interesting slides that you can talk about. And then Hannah's going to cover a little bit of investments without telling you exactly how we manage assets, but it will hopefully flow through in a logical way for you. So if you just flip to the next slide, please. And next one, please. Okay, so I'm going to talk about three concepts today. It's just the next one, please. If you think about the three most relevant concerns of investors and why we've seen a big pullback in the market, it's focusing around inflation and the impact of a more hawkish central bank regime everywhere across the world, except perhaps for Japan, where they still haven't really increased rates at all. The energy shock that we have, I know it's very popular to blame Ukraine for the energy crisis we have at the moment, but it has been a long time in the making in terms of the underinvestment in that sector. And then of course China, and all three of these, China and the ongoing COVID policy, as we speak, it's a very opportune time to speak about these things because the reality is that all these three things are coming to a head. If we look at the big picture, I think there's a very important chart to look at. Trillion, of course, is that phenomenon. It has 15 noughts behind it. So if you think about mostly the Western European world, $18 trillion of bonds were invested mostly in pension funds, and it was yielding a negative yield. At the maximum point of pain, I think 2 to 3 billion, maybe as high as 4 trillion, dollars are actually corporate debt, not sovereign debt. So as an investor, how can I explain this? This is me giving money to Nestle for 10 years and then getting less money back. I'm paying them interest to keep their bond. A truly big bubble, an obvious bubble, but at the height of any bubble, no one ever wants to talk about it. But this bubble had consequences for equity investors like ourselves as well. I don't know how this, I have to point. The reality is if you're a UK investor like ourselves, with bond yields finally picking up and bonds capitulating in US dollars, UK equity investors have actually lost 50% in what actuaries told them is a very safe asset class. So it's extraordinary times we live in. Clearly, when we look at bonds in particular, and the fact that risk assets are priced off bond yields, then clearly it had an impact on other asset classes as well. And this is, I'm so sorry, now it's working. If you look at the impact over the long term as well, this chart shows you that on a rolling 10-year basis, bonds are actually giving you barely a 1% return. So where it was very good for bonds was of course in 81, and that's really the playbook we have at the moment. Back then inflation got squashed. I think the Fed rates certainly went double digits. I don't give you the exact number now. But that set up the scene, treasury yields went double digits. Then you had this huge period of disinflation. And you see those annualized returns spiking up towards 1991. That's, of course, the last time the US had a proper recession around the Gulf War in 1990, George W. Bush Sr. at the time. And then, slowly but surely, bond yields picked up. There was, I don't know if this pointer will work, but there was a brief point where the annualized returns in bonds were better. That was, of course, during the financial crisis. You see it here. You see it there during the sell-off in the global financial crisis, and briefly again in 21 when we had a pickup, then you actually notice that the bonds did really well. But what has happened this year, and this is a graph that shows you the impact of the wealth destruction we've seen. Back in the global financial crisis, we had a 50% pullback. Why is this thing jumping forward? In the global financial crisis, we had a 50% drawdown, mostly in equities as a percentage of GDP in the US. This time around, it's a combination of both bonds and equities collapsing. So, bonds being down 20% is the worst outcome, I think, since 1944. So that is a really, really catastrophic outcome. Now, Hannah's going to turn more positive in the next 10 minutes and tell you what have we been doing as investors around this. But I think it is very important that you have to be correctly positioned going into this. I think the anatomy, and I've lived through 3 bubbles now in my career, the 2000 NASDAQ bubble, the financial and mining bubble in 2007, which led to the GF global financial crisis, and of course, the sort of what I would call the everything bubble a year ago with very few hiding places. And why do we call it a bubble? This is a price to sales ratio of the S&P. Now, if we look back at October 98, 99, when I started in the investment world, as a youngster, I sort of, 3 years later and even 10 years later by 2008, it wasn't exactly the playbook that you joined the investment industry. This is not the way it was supposed to be, that you go into a 10-year bear market. But valuations are a very important starting point and very central to how we think of investors around the world. And if you look at the price to sales ratio of the US, I thought back in 2000 I would never see the likes of this bubble again in my lifetime. But some things happened: quantitative easing, money printing, things that, concepts that the doctor will perhaps, cover for us as well, concepts that became mainstream. The argument became that money printing is working, it's new monetary theory, all the concepts that we think will work, and in fact it didn't work. Things returned to normal. It's still quite expensive in the US. Hannah's going to just touch upon a little bit of China, and I will talk about that. Fascinating what's happening right now in the markets. But we still have to be careful. There's still a bit of unwinding to go on. Let's cover a little bit about energy. So I've just taken this straight from Elliott Advisors. It was a letter they brought out during their quarter end. And I'm not going to repeat what they're saying there, but what I would add to is, why do we have an energy shock? It's simply that 85% of the most important input in the world is still driven by oil consumption. The reality is it's going to take us a long enough time to transition to alternative energy. The second concept that we must face as well is that the move to an alternative energy system is ultimately sponsored by a lot of governments. Now, as an investment professional, and I've got to be careful what the saying is, but I think the saying is don't confuse a great story with fundamentals. Because of course a lot of investors will latch onto alternative energy as a way to make money, but this is a much bigger issue just in terms of what you can do as an investor. This is a critical issue for all of us. I don't have the answers to this, but what I do know is when you look at the reality of alternative energy, there are 3 issues that we face with the sector, and it's the high cost of course, creating an infrastructure where you can save energy. It's not a sarcastic comment, the second point, but intermittent energy is just that. If you're on solar power and sun don't shine, or if you're on wind power and the wind don't blow, then it's not like oil where you can burn it, it's there available 100% of the time. It's going to be very costly, and the cost of putting that infrastructure in. The reason we might have the iron ore price going up is not because China's got a huge demand for iron ore in their building and construction. It might be that it's a reality. Putting up some of these solar systems and wind systems require a lot of iron as well, and it's going to put tremendous pressure on the price of certain mining costs. Also, just big picture, if we think about the world we live in and the trends we're seeing as an investor, How much time do I have left? But if we look at, if you think about 2 years ago and what was hot in the investment world, it was all about, stay away from China, it's all about tech, it's all about the US. And yet when we now look back at that infamous 6th of November day when we announced that there's a cure for COVID, what's actually been working in the market has been the energy sector. In fact, that graph's probably a little bit out of date. It's now at the point where energy sector and the information technology sector over a rolling 5-year period is almost neck and neck. So it's just trying to make that concept clear that a story or a narrative versus the reality can sometimes turn out a lot different. So the fact that we've seen so much underinvestment in energy, it does mean that ExxonMobil, for example, is printing $30 billion of free cash flow at the moment. That's tremendous amounts of free cash flow, as does Shell, as does BP. So as investors, we've got to be careful not to confuse a great story with bad outcome. And that's really what happened a year ago in technology. You can see there technology is the actual pink line there. That's the one that's been underperforming. It's done worse than MSCI over 2 years. Financials have done quite well as rates went up. And the energy sector has actually been a superstar and went from 2% of the world to 6% of the world index over time. And then if we talk about China as the last thing I just want to cover, the way to read this graph is, I know that the president of China had a meeting with Biden. Unfortunately, because I'm on the road, I'm not quite sure what he said, but I take it that the market's been very positive on what he's been saying. Also, China is not as dependent on the US as it was maybe 32 years ago. The way to read this graph is that in terms of the percentage of countries outside the US trading with China, it's now 70%. Only 30% of their trade is done with the US, whereas back in 1990, it was as high as 95%. So, what we're seeing is China's growing its presence. It wants to do the right thing, I believe, long term. I hope the Taiwanese issue has been solved in the short term. We've seen a big rally in Taiwan semiconductor over the last few days, few weeks, but China certainly will carve out their own path over time. And if you look at the stock market, what I've done here is the blue line is China going down, the red line is the UK going down post-Brexit, and eventually the market has a way of overreacting. Can it be that China is perhaps a good investment opportunity just as everybody's negative? We have seen, and I checked my Bloomberg this morning, so we have 4 Chinese stocks in the portfolio. It's gone up 31% in 7 trading days. So what I predicted perhaps could happen in this graph, that blue line is now already out of date and probably hovering 30 or 40% higher already. And you see it over here in the graph. It's just a bit of a delay as you press.
Question?
Yeah, so that blue line shows you the underperformance of China, and it also shows the underperformance in the period leading up to Brexit as well in the UK. So, often bad news in the markets discounted, good news always over discounted mostly, and it is very encouraging what's going on in China right now from an investment point of view. I think it's probably a lot of negative sentiment in there. So just on the next slide. At this point, it doesn't seem to work. You could just Also, big picture, just thinking about emerging markets, China is part of that. This shows you a graph in terms of the relative premium or discount to the rest of the world, and you can see there hovering at the bottom end of the range. So we do have some emerging market exposure. We are not macro strategists, but we do find emerging markets interesting in terms of valuation. And then before we pass over to Hannah, the last chart will just show you also the MSI from an emerging markets from an absolute point of view. So, of course, you are in emerging markets. It's really a very small part of the world today. There have been periods where the emerging markets have outperformed very strongly. A period like 2000 to 2007, the period after the Nasdaq bubble and towards the peak of the global financial crisis before that happened, emerging markets actually had terrific outperformance. So I'm just leaving that out there for you maybe as a point to think about. At the moment, the US is close to 72% of the world market capitalization. Perhaps that could change over time if that's overhyped. I think that's it from my side. I'm going to pass over to Hannah now just to take you through some of the investment concepts. Thank you.
Yes, the next slide, please. So Peter spoke about some of the extremes we've seen in the market, particularly over the last 2 years, but there are 4 key tenets that we believe that us as investors ought to follow, particularly in the lights of these extremes, but also over the very long term. And these are concepts that we have been following for almost 2 decades now. And the first is to stay away from unsustainable business models. So we stay away from unsustainable business models, and I think that has really, really come to light this year. We invest in quality businesses, but we must not overpay for them, so it's not quality at any price. And again, the impact of overpaying for those businesses has particularly been brought to light this year. The third is to invest in businesses in secular growth industries. And so we're looking for companies with very strong business models, high barriers to entry, that have growing demographic trends behind them. And I'm going to give you some examples of those later in the presentation, particularly now how we're seeing valuations in the market, certainly in certain subsectors, looking much more favourable. We're able to buy into these businesses at much more favourable valuations. And the last is to always be prepared for an overreaction in times of extremes. So if we just move to this one. So first I wanted to highlight what can actually happen if you do invest in unsustainable business models. And so you can see this is the drawdowns from the 52-week highs in a selection of names. And you'll see at the top of this slide here the likes of Peloton, the likes of Upstart, Carvana, Teladoc. Now these companies did exceptionally well in 2020, and perhaps it's one of the only environments, very particular environment where these companies could do very well. We had fiscal stimulus, we had very low rates, and we also have these concepts. We're never going to go to the gym anymore. I'm never going to go and see my GP in person. I'm never going to go and look around a car in person before I purchase it. Now we're all sat here today back in the room. We're not sat at our homes watching this together in laptops. So I think we've proven that those concepts perhaps have not come to be the case, but these companies did exceptionally well in 2020, but as the market started to get worried about the Fed putting up interest rates, the impact of inflation back at the end of 2021, we started to really notice these impacts in the market. These companies sold off dramatically. And you can see here what we're really trying to do as investors is to avoid permanent loss of capital. We think that's so important. And so if you've got to ask yourself, if you're a company like Peloton that's lost 90% of your value, you've got to go up 1,000% to make it back to where you were mathematically. So we really, really want to avoid these permanent losses of capital. If you look further down the list, good companies weren't spared from the washout we've seen in the market this year either. You'll see the likes of Microsoft in there, you'll see Intuit, you'll see SAP. These are all companies we have either bought this year as the markets have sold off, or we have been long-term invested in, and we've been able to add to our positions at more favourable valuations. So there are opportunities out there now that we're starting to see a more reasonable environment in terms of valuations in high-quality companies. So what I've done here, just to illustrate how extreme some of these things got, is I've taken a basket of 50 high-quality companies. Now these are companies that we believe have very good economic moats, excellent balance sheets, strong operating margins, the ability to sustainably grow their earnings over the long term, strong management teams. But they became exceptionally expensive during the pandemic, during 2021. And if you have a look here, it's just a forward price earnings ratio. These basket of companies where we completely forget about valuation, we're trading on average at 30 times forward price earnings ratio. So if you're a stock picker and you're trying to buy yourself a portfolio of high quality companies, it was a challenging environment over the last 2 years to buy those at a reasonable valuation. Instead, you've got to ask yourself, if you are starting at this point in 2021 at 30 times forward earnings, your return expectations going forward are therefore much, much lower because your starting point is much, much higher. So we've seen this drawdown this year, and this chart includes the likes of Intuitive Surgical, a leader in minimal invasion technology, S&P Global. These are big names that you will recognize. Many of these names have halved this year to date, and so it really has been quite extreme. So I wanted to highlight to you that even if you are buying fantastic businesses, you may not be spared from very drastic drawdowns if you do overpay for them in the first place. So just to illustrate instead, to give an example of what we've done in our strategy, in comparison, you'll see if you look at the scale on the left side, again, this is a forward price earnings ratio. You'll see it moves, instead of up to between 15 and 30 times forward price earnings ratio, you'll see it's actually between about 12 and 16 odd forward price earnings. So it's much, much cheaper. And you've got names in there like Visa, Microsoft, London Stock Exchange Group, very high quality companies. Also against some optically cheaper companies like British American Tobacco. It's done exceptionally well over the last 3 years, very cash flow generative. Very high free cash flow yields. Companies like Fiserv, which is boring, the banking and merchant technology. But that starting point for those valuations is much, much better. And it shows that if you are actively managing your portfolio and being careful about your valuations, this portfolio has notably outperformed the market this year and protected on the downside. And so if you are careful about your valuation discipline, then it will help protect you in times of market extremes when most expensive companies are selling off. So I spoke about secular growth industries, and now I just want to highlight a few examples in different areas of the market. This chart shows you about how we're all getting older, we're all living longer. It's the ratio of over 65s in the US compared to 20 to 64-year-olds going out to 2030. As we live for longer, we're going to need more healthcare, more procedures. In the US, of course, you need medical insurance. And so this is one of the demographic trends we look at, and how we can reflect this in the portfolios through a name like Elevance Health. It's one of the leading health insurers in the US. But if you have a look there, it was very out of favor during September 2020. And that's because the market was really worried that companies wouldn't be looking after their employees so much anymore because of the cost of health insurance, because of the impact of the pandemic on people. But actually what's happened is people have been really, really enrolling in health insurance. They don't want to be caught out in this situation again, so their enrollment numbers have been very good. You can see if you look at the red line, their earnings growth has been exceptional. It was it was trading very cheaply back in September 2020, and this is what we're looking for, these kinds of dislocations in unappreciated companies that are in these growth areas in the market. And as a result, since that position was purchased, it has outperformed the market. This is a relative return chart by almost 100% over just the past 2 years of holding period. Now, these are exceptional divergences in the market for it to be outperforming so strongly at a time when there is market weakness, but it just shows if you pay attention to valuation, it's a company with a solid balance sheet, and it is in this secular growth industry where there is increasing demand, the company is executing very well. There are these opportunities to make good money at times when there are opportunities. So as value investors, as I'm sure you know, if you see a graph going parabolic like that, then it's always time to sit up straight and pay attention. So actually, we followed our valuation discipline and sold out of this name. It's down about 15% in about 2-3 days afterwards. So it's actually really interesting. Just as the market's rotated this month, these more boring defensive businesses have become out of favor. A very good example of an exceptional business that was trading at an exceptionally high valuation, 58 times forward price earnings ratio, less than 2% free cash flow yield for Intuit. It's an online accounting software business in the US. It's almost 100% dollar earner, which with the dollar strength recently has been very beneficial to them. They do QuickBooks, you may have known it, tax, TurboTax. They also have Credit Karma and MailChimp, which is mail advertising. They have a very good ecosystem. They trap their customers within it, and they allow them to use all of their services. Now, Peter spoke about the risk of inflation. This is a company that has very high barriers to entry because they are the leader in what they do. They have an exceptionally sticky customer base. They've just put their prices up 20%. Now, this is what's important about high quality companies, is they're able to pass this through to their underlying consumers. And so, when you have a company that has that sticky consumer base, they're able to do that. but we didn't want to overpay for it, and we've been watching for it for a long time. And you can see there, the blue line is the forward price earnings ratio, the white line is the earnings per share on a rolling 1 year forward basis. And that company corrected almost 50% at the start of this year. It's a very high quality company, but as we say, baby got thrown out with the bathwater just as investors in the market started to become more concerned about valuation. So we're able to enter that position at a more favourable valuation, but it was very, very important to wait, to be cognizant of that valuation, to just stand back last year when it was looking exceptionally expensive. One more example is Thermo Fisher, which is a leading life sciences business. They do testing for pharmaceuticals, gene therapy, and it allows you that exposure to the growing drugs market, to the healthcare, this phenomenon we're all going to be needing to be looked after. Of course, they had the benefit of testing during COVID. Now, they're not the lateral flow tests, they're the more complicated molecular level testing. And I think this concept of continuing testing is going to stay, but the market has become concerned that that was actually a bigger part of their revenues than is very true. It's actually a very small part of their revenues, this COVID testing. So it's sold off recently, which has allowed us to enter the position. But it's very important that we were waiting in this name. It's this concept of having this list of ideas of very good businesses in these secular growth industries, but not wanting to overpay for them. Because if you overpay, you can be very susceptible to these drawdowns in the market. I just wanted to highlight a couple more examples here. We have seen a lot of weakness in the market this year. Certain subsectors have really come off. We had half the companies in the NASDAQ half, for example, this year. But did you know 40% of the companies in there actually have no earnings at all? It's really quite staggering. But the starting point for some of these high quality companies, and I mentioned some of them earlier, Intuitive Surgical, there's IDEX Laboratories, for example, which is a leader in animal healthcare. We're talking nearly 80 times forward price earnings ratio. So even though many of them have halved this year, we're still at a point where optically, in absolute terms, we are looking still quite elevated. So whilst we've had opportunities to invest in some high quality businesses at better valuations, we must just be mindful that certain parts of the market have come from such high bases that we just must be patient to wait before we invest in them too quickly. So in summary, I think it's really important now to focus on balance sheet strength of company. I was asked yesterday by some investors about companies' debt profiles. Will they refinance? Will it be more expensive? We like to not worry about that, and I think that that's really important. So we like to be looking for companies that do have those clean balance sheets. We want companies with superior pricing power. This year now we're starting to get some really fantastic opportunities. So if we look below the headline numbers, companies like Apple, for example, have held up exceptionally well here today. It's still looking quite expensive. So we need to look into those subsectors like US software, like US medical technology, where we're starting to see much more favorable valuations to be able to invest in these companies. And we've got to do it only where it makes sense. So we've got to just be mindful not to overpay, but I think if we abide by these rules and try and embody them over the long term, we can show significant outperformance over the market. And we don't always have to overthink it to be able to do it. I just wanted to leave you with this last chart, which is a relative performance chart of Johnson & Johnson and Yum Brands. Two perhaps of the most boring businesses out there, Kentucky Fried Chicken, Pizza Hut, and you all know Johnson & Johnson, but these are companies, and this is just run from the date that we launched our strategy back in 2008, that have outperformed the index by 170% and 300% total return just over that time. And you'll notice also that these boring compounders, the compounding way, also tend to do very well in times of market stress. So I think that's something just to leave us all with. Thank you.
Thank you, Hannah. That was fantastic. We'll dive into a few questions just now. Now over to you, Dr. Thiepenin, to bring it home and give us some Mauritian perspective on these global trends. Thank you very much.
Thank you everybody. Look, I hope you've gained some insight that even when there's blood on the street, the opportunity is to make money and make return, depending on when you invest, how you are disciplined, and how you exit. Now, you've heard a lot about what I would call Wall Street. I'm going to speak about Main Street. You heard about the financial market. I'm going to speak about the real economy. And we started, both globally and regionally, and even back home, quite well, after having suffered, from the economic impact, the health impact of the pandemic. And we were on course, probably, to recover in some sectors, what they call the recovery rate, until Russia invaded Ukraine. And let me be very candid. All the sins of the world should not be placed at the doorstep of Mr. Putin, because there were deep structural and long-term issues that were already there. However, what happened? They get amplified by basically the COVID pandemic and by the war in Ukraine. And let me try to spell out what I think will be the broad macroeconomic climate against which the financial market and Wall Street will have to operate in the next probably 18 months. I was telling my colleagues, it's not good to be a messenger of not very good news, but you should not shoot the messenger because the news is not good. So the first headwind, and I think the most important one, is inflation. We've never seen inflation at that particular level across the world, more so in some countries. I was reading Ghana this morning, and it's quite tough, the rate of inflation in Ghana. But even in countries like the States, in Europe, where they try to anchor what I call inflationary expectation, inflation has been very high. And I think the Prime Minister of the UK has said this is the single most important problem that we have to tackle. But there are some policy options, and they're quite tricky. And the challenge with inflation is that, but how much the central bank will have to raise interest rate in order to bring it down in America to 2% or in Europe to 2%, because you're starting from a high rate. Now, some economists believe that probably inflation is peaking. If you look at the latest figure from the US, that's come down slightly. But I think inflation will remain quite elevated for some time to come. And unfortunately, central banks will have no choice than to raise interest rate. The only question is that, are they going to overreact or underreact? I have a good friend who's a doctor. He tells me that very often the operation is successful, but the patient dies. And the patient here is the economy. So this is the first headwind. The second one has been alluded by my fellow panelists, is the energy issue. Again, it varies. If you're in America, you've got use reserve, you've got shale oil, shale gas, probably it's not a big problem. If you're Germany, it's a big issue. If you're Poland, it's a big issue. And how long the war will last, I think only Mr. Putin knows this. You saw what happened yesterday. While the Foreign Affairs Minister Lavrov was leaving to protest against the communique, they sent 100 missiles across all cities in Kiev at the same time. And 50% of people in Kiev don't have electricity. So there's a lot of geopolitical tension, and nobody knows what's going to happen on the energy level. And the best thing that could happen is that there's a negotiated settlement. There's peace, and energy is back, and we're not going to be affected. And there are many countries in Africa that rely heavily on food import and on energy import. And it's going to be an absolute disaster for these countries. The third headwind, which is a consequence of number one and number two, is basically rising interest rate. And rising interest rate, while absolutely necessary, I keep telling my friends in Mauritius, it is true that it is supply shock driven, but the central bank cannot ask Mr. Putin to stop the war. The only thing that central banks can do is to play on the demand side and to bring down demand so that inflation obviously comes down at the same time. And you need to protect your currency also and to defend the currency. And there are not 25 ways to do this. I tease my friend who asks me where to invest. I say, well, the dollar, you yield 2%, and the rupee, 3%, you invest in the dollar for one simple reason. It's a one-way bet. Today you can get interest on dollar at 4%. So obviously you don't need a PhD in economics to know what to do. Okay? So interest rate is creating a major problem. I hope we'll have the chance, to see how this is going to impact many countries in Africa, because the debt is high and the servicing of the debt also is going to be high. The fourth headwind is basically a strong dollar. We know what has happened. Interest rate has risen by more than 300 basis points in America. It's not the end. Unlike what some economists were saying yesterday, the rate of increase is going to decrease. So maybe it's not going to be 75 basis points because inflation has come down. The third thing that they're winning the war, that is a long way to bring down inflation to 2%. So maybe the next hike will be 50 basis points, and still, America is exporting most of its problem to the rest of the world. So rising interest rate and a higher dollar are going to wreak havoc in many parts of the world. The other one, it's basically the climate crisis. I mean, this is an absolute disaster. I understand the point made by the gentleman here, but if you don't take the pain now, we're talking about existential threat down the line. And let me be very candid. The conference in Sharm el-Sheikh is an absolute fiasco. They have failed on 3 major metrics. In terms of mitigation, I think 1.5 C is dead already. The best you can do is probably under 2 centigrades compared to the industrial revolution. Second, there is not enough money, both for mitigation and for adaptation. And 3, they have put basically what we call losses and damages on the table after 10 years of discussion, and there's no money coming. There's no money coming for the next 15 years. So it's going to be an absolute disaster, especially for many low-lying countries. Even for a country like Mauritius, the coastal region is going to be impacted. The other issue, is we are having this at a time when there is hardly any fiscal space by government across the world to support the economies. Because it's as if you have a gun and it's loaded and you have fired all your ammunition to fight COVID. And now there's hardly anything left to fight basically what's going to happen. And then you have the issue of how long will the recession last and how deep will the recession be. Now in some countries, let's be candid, they're already in a recession, but you get the data only 3 months or 4 months later. I mean, it seems to me that the UK and Germany are already in a recession. China, the rate of growth is going to decline. India is holding up, but many countries, the IMF, I think, is right when this is going to be gloomy, uncertain, unpredictable, and the clouds are darkening. So, this is a bit the background that we are facing. Now, if inflation comes down, at what price will this come down? I think this is the key question. And then what strategies should we adopt? And there are 3 types of strategies here. One, you tell me when I have to stop. One is at the global level. It's very clear that you need coordination, you need collaboration, you need coordination at the level of the world in order to have policies that is going to address both the monetary issues and the fiscal issues. I'm not sure that the G20, they still have 1 day left. I'm not sure the G20 is going to reach any agreement on how to handle this issue. There's too much, again, politicization. I don't think they're going to reach an agreement in the communique, or the communique is going to be so broad that everybody can read what it wants in it. So it's quite tricky. The IMF will have to play its role in providing probably emergency support to many of countries in Africa that will not be able to pay their debt. This is another big elephant in the room. The debt of many of these countries are very high. I don't see how Malawi is going to service its debt. Impossible. With rising debt and higher servicing of the debt, and probably this is going to be the single most important expenditure in the budget. The same will happen in Mauritius. It's going to exceed expending on education. So, and I think what many of these countries will have to do, build resilience to what's happening, that's very important. I think you need also to mitigate the adverse impact. It is possible. There are countries, I think policies matter. There are some difficult policy choices that have to be made. And for instance, I believe it's impossible to protect everybody. You listen to what the Chancellor's Exchequer will do tomorrow. It's a tightrope because they have such a fiscal hole, and you will have to do both. You will have to do an increase in taxation and a decrease in expenditure. Now, where do you do it? How do you do it? Over what time? Who do you protect? Who you don't protect? It's a tricky one. It's a tricky one. So I think many policymakers in many countries of the world will have to make these difficult choices about how do you contain the adverse impact of what's happening globally. And it's going to vary from country to country. There are some countries that are very open economies, like Mauritius, like Singapore, a bit like South Africa maybe. So they are going to be impacted more. Some countries probably they're going to benefit, on the coattail of higher prices of energy. If you're Angola, if you're South Sudan, but even there, inflation is very high. So I think it's going to be very tough. And I think what some countries will have to do is basically how do you protect people in the short term, and how do you implement structural reform, supply side reform, in order to do A, B, C, D. In Africa, A can be shorten the supply chain through regional integration, especially after we have had the signature and the coming into being of the continental African free trade area, and how you can fasten, basically regional supply chain in order to reduce your dependence, on very long supply chain from other countries. You will also have to make sure how do you protect some of the vulnerable groups in Africa. And let me be very candid about it. I do some work in Africa. Unfortunately, what Africa has gained in 10 years in terms of poverty alleviation, and in terms of creating employment opportunities, have gone in almost 1 year. There are so many people, who have lost their job, who have lost livelihoods. And again, you can see the disaster, of what's happening in East Africa, whether it's in Kenya, in Somalia, or in Ethiopia. The impact of the drought on these people, what's happening in Pakistan. So I think policies regionally, policies domestically, policies at the global level in terms of coordination, and the big boys and the big girls, have to play a more significant role. But it comes at a difficult time. How do you convince the UK that is facing a big gap, a big fiscal hole, to give more money in terms of development assistance? I mean, they have already played, a first game on us. They have reduced, the percentage from 75 to 0.5, and now they're counting all the aid they give to Ukrainian people as part of the 0.5. So I think it's going to be tough, and we will have to navigate these tough, probably 18 to 14 months, by, as I said, building resilience, mitigating the adverse impact, and also trying to protect the most vulnerable group. So I look forward to exchanging, some on some of these issues on the Q&A session. Thank you.
Thank you very much.
Thank you.
Okay, so what we can do now is you guys can start thinking of a few questions. I'll maybe lead with the first few, and then when you're ready, Kim's walking around the mic, and just put your hand up, and Kim will come to you with the mic, and we can squeeze in some good questions. So core thread that came through everyone's presentation is focus on inflation. If you look at the cumulative annual growth rate of inflation over the expected interest rate hike cycle, how severe will inflation actually be in each person's view? We say 7% per year, but when you compound that over 5 years, what are prices going to double? I mean, what are we going to experience in our lives?
So I'll have to go at this. In terms of what we do from an investment point of view,
We have very few sort of typical manufacturing type businesses. So if you look at what we've done the last 12 months, we've bought into, as Hannah mentioned, London Stock Exchange Group is a data service provider. Visa Corporation, of course, is a service industry. Intuit Software also doesn't have any, stock on their balance sheet. They're a software company. So typically we, in our portfolios, we try and just through the nature of high quality investing, you're not that sort of prone to inflation issues. In terms of certain defense companies that we own, like General Dynamics, they have built-in inflation protection in their contracts when they build a submarine or a vessel for the US Army. And of course, the argument is that we live in this very strange bipolar world where you have inflation on the lower and middle class, but the so-called upper class, or those individuals that operate at the very high end of the wealth spectrum, they are unaffected and they don't care paying more than 15 or 20%. If you look at the numbers of Louis Vuitton, they don't care paying more for their luxury handbag. So it's a very, very difficult thing. I don't have all the answers. All we try and do in our process, though, is to make sure that we're not invested in those companies where inflation will be very sticky. Certainly, even your very well-run businesses like Reckitt Benckiser, ABI, InBev, Heineken, all of those companies, even though they have pricing power, they have seen very big pressure on earnings because their input costs have been going up, and it's not easy to pass those through to the underlying client.
Look, I think it depends on a couple of policy issues. Now, everybody has been talking about food inflation and energy inflation, and in some cases in Africa on fertilizer also having got the 3F, food, fuel, and fertilizer. My concern is that core inflation, what they call it core 1, core 2 inflation, where you remove food and energy, has also been going up. And this is a cause of concern. And now, with interest rate rising in many countries, mortgage rate also is going to increase. So this is going to add to inflation. Now, of course, it's going to vary from country to country. I mean, look, France is doing better than probably the UK because the share of the energy that is produced from oil is quite low. They rely a lot on nuclear energy, So it will vary. And then it will depend on basically how coordinated monetary policies is across the world. Up to now, it's been really coordinated. All central banks, I think except Turkey probably, have raised interest rate in tandem. Now, it will depend on how fast inflation will come down. But there's an inverse relationship. The more you raise interest rate, like in the US, I think, if my memory serves me right, they've raised it 3 times by 0.75%. Now, obviously, it's going to be tricky, and you can reach the situation, the anecdote that I gave. Operation is successful. You brought down inflation from 10 to 2%, but then you kill the economy. And then you have exported this to the rest of the world. So I think it will have to be work in progress. And I think this is what the Fed and other central banks are doing. They need time to assess the impact of monetary tightening, not only in terms of interest, but also in terms of quantitative tightening on how this feeds through the system. And it takes time for an announced policy and how it feeds into the system, what we call the transmission mechanism. I think if there's a recession next year, there's an inbuilt mechanism that demand is going to drop, and if demand were to drop, there's going to be less pressure. And I don't agree with some economists who believe that it's totally supply-driven and import-driven. That's not true, for the simple reason that demand also has surged after the COVID. So there's an element of demand also in what's happening. And that's why I think it makes sense, for central bank to do it. The concern that I face is basically for emerging countries and developing nations, that they do not have independence on the conduct of monetary policy, because if they want to defend their currency and they want to prevent a capital outflow, they will have no choice, basically, than to follow what the US is doing. You saw it in Mauritius. Outside the cycle of monetary policy, they have had to intervene and raise it by 100 basis points. So I think it will come down. The speed with which it will come down, however, will depend to a large extent on how strong the interest rate is going to rise, but then there's a policy trade-off. It might impact employment, it might impact growth, and it might impact what happens in other countries in the world. Thank you.
Thank you, Dr. Sitani. You want to add on inflation, or can I answer that question?
I think I would just probably add that market is of course forward-looking, and we started to see these worries really come to the fore. It's about a year ago now when we started to really think about the impact of inflation on the market. And you know, the market is up 5% now month to date, and we had a really big reaction on the back of the latest CPI numbers, which I think were a 0.3% increase, slightly lower than we expected, but the market really took off. I think we had the Nasdaq up nearly 7%, sorry, on the day, and so the animal spirits, so to speak, were really with us. But of course, it is still increasing, so I think we have to be just mindful of where we're at. It was up, I think it was 7.7% year on year. So I think that whilst we have had a lot of pullback in the market, perhaps we should just err on the side of caution. And it was quite an extreme reaction on the day of that move, which of course was still an increase.
Fantastic. Yeah. I mean, I think it's really hard to try and tame inflation, because every time you increase interest rates, the base has gone up. So you get diminishing margin utility. And for us sitting in emerging markets, we're fighting a losing battle, because the Fed prints the money and they set interest rates first, and then we, as Mauritius, South Africa, and emerging market economies, we have to follow that. And then what often happens is, because we're all afraid of our currencies devaluing, we all buy the dollar, and it's a vicious cycle that then forces the dollar to get stronger, which is why, I mean, Turkey is a radical case. But if every emerging market currency said, okay, we're going to stop buying the dollar and buy our own currency, maybe we could reduce the effect of that. That it's a rigged game that major markets can't really win. Anyway, so just over to more questions from the audience. Anybody with a hand up? Some questions at the back.
Hi, Julia Hawkins from Hawkins Sabadell. I had a question for Dr. Sithanan. Is that correct?
Yeah,
Sorry, just trying to get the pronunciation.
No problem.
What is your view on how Mauritius should deal with the energy policy going forward in terms of mixes? Because you mentioned nuclear, you mentioned renewable energy. I also strongly believe in renewable energy, because that's what I focus on. I originally come from Sweden, where we have a mix of renewable energy and nuclear. But in terms of Mauritius and in terms of where we should be heading, what's your view on that?
I think it's very clear. It's very clear to all of us that we have to act at two levels, on the supply side and on the demand side. And what I mean by the supply side is basically you need a transition away from fossil fuel towards basically renewable energy. And I think government has got it. My only concern is probably there might be a big gap between the rhetoric and basically what's happening in the market. And I think on the other hand, you have to put a lot of emphasis on what I would call demand efficiency. I've been putting a lot of emphasis in this since I was minister. You know that it has happened in many other countries. For each unit of dollar of output that you produce, you use less electricity. And that makes sense. So we have to do both at the individual level, at the corporate level, and at the institutional level. And I think we need to put equal emphasis on demand management as on the transition to renewable energy. Now, the challenge that we face is that the numbers are very stubborn. You know, if you look at the share of renewable energy, and if you make abstraction of bagasse, I mean, we've been using bagasse before I was born, you know, so there's nothing new in bagasse. So if you remove the share of bagasse that is in the supply of energy, the share of the other renewable energies is very low. And at the margin, because the amount of sugarcane is coming down, it's going to be highly difficult unless you have a technological revolution that is going to make more energy from the same amount of bagasse. So you're relying a lot on basically solar energy, wind energy, and some hydro. Now to reach 40% in 2030, I think it's very challenging. But you need to continue to have policies in place that will ensure this transition. Now, whether the transition will have to go, I don't know. I mean, some people say that there's small nuclear power. I'm not sure about that. I'm not an expert. But it's very clear that probably gas could be a transition. That could be a transition for a country like Mauritius. But I think it's going to be quite tough, because when we say 20% of energy is renewable, we're including the 18% which come from bagasse. And this is going to be fixed for a very long time. On the contrary, the share of sugar, is coming down. So I think it's the right policies. We have no choice. It's going to be an existential threat for us. Temperature is already higher. Rainfall has dropped, and the sea level are rising. And you can see the coastal erosion. So for small countries like Mauritius, even though we are not low-lying like Maldives, we can have internal migration. We don't have to buy land in other countries, to displace our population. But there are some places where we'll have to displace our population, Rivière des Galets, in the south, where they will have to go probably, higher up. So I think it's the right policies. What is unclear to me is whether we are going to achieve the goal in the time frame that has been laid out. And some of the policies are the right one. In terms of automobile, we are encouraging electric car. So we are using the bonus for electric car, and we are using what the French call the malus, for fuel, for fossil fuel. But I'm a bit concerned about the speed with which the transition will happen and the harm that it could do in the meantime. Thank you.
Next question. I'm Jean Béchard to Dr. Sitanen. Do you foresee an increase in unemployment worldwide coming and then resulting in a recession? If you see like Twitter, like Microsoft, like Amazon are retrenching people, do you see that as a menace for the future to come?
No, the technology sector has been highlighted, by the lady. They have got some specific problem, They have been impacted much more than the other companies. So they will continue, I think, to be impacted. Now, the Americans are not doing badly as far as unemployment is concerned. And that's why there's a big debate in America, whether we should restrict ourselves to the narrow definition of a recession that is 2 consecutive quarters of negative growth. Because they're saying that unemployment is not that bad, consumption is not doing very poorly, industrial production is not bad. But in other countries, it's very clear that that's the aim. If you're going to raise interest rate, I think interest rate will continue to rise probably until the first quarter of next year. I don't see inflation coming down sharply. It's going to come down, like from 7 to 6 to 5. Now, their objective is to bring it down to 2%. I'm sure you remember what has happened, 30 years ago. When a gentleman raised it to such an extent that we landed, in a recession. And when you speak about bringing down and increasing the interest rate, two things that come to mind. Growth is going to be lower, and obviously unemployment is going to rise. So I think this is going to happen in many countries in the world, except in countries where you have a declining and aging population, which is the case of Mauritius, where the dynamics could be different.
Next question.
Merci. Sanlam Kim from the ECDC. I can understand a bleak future for the months to come. We used to live in a dollar-dominated economy. Now there seems to be sort of fractionalization, trying to build an anti-dollar economy, like the coalition with the Chinese and the Russian and the BRICS. You used to say that if inflation goes up, it's very difficult for it to get down. At the same time, printing the dollar, at the same time, raising interest rates. So there's a cocktail of measures that are being taken by the rich countries, not by the poor countries. So no matter what you do, you're affected by the human decisions and also climatic, ecological phenomenon throughout the world. Now we are concerned about our cost of living. So we're concerned about getting inflation down. My question is, do you think a sort of barter system between middle average countries with one another can in a way soothe the impact to the cost of food and fertilizers?
Look, I mean, it's a very good question, and it's maybe I can have a punt at what's happening in Europe. And as my panelists have said with me, you know, it's the European experiment from it's now 30 years in the making. Even now, you see the very you know, the whole theory around the European Union and how there will be one monetary union and one economic union. It's worked out very different just because of a simple policy of how you handle energy. And you know, there's this very famous meeting that Trump had 4 years ago where he told the German delegation that they're crazy to rely so much on Russia for energy, and he was laughed at. Now, the reality is that you know, these consequences come to a head a couple of years later, but it's a very difficult moral issue as well, because if the French, when it comes down to things like energy, if the French are believing in nuclear energy, and yet, you know, our government in the UK is starting to shut down all the nuclear plants as we speak, and that is a long process. These things have consequences. I think Germany's in a bit of a difficult situation, because they shouldn't really be in this scenario if you really had a common grounds in terms of the European Union, but the reality is that the German economy is just much more industrialized than anyone else. The concept that I heard you know, being mentioned earlier around better cooperation between Africa as well to try and alleviate some of these concerns, not something I'm familiar with. I don't know if it's working. I mean, my gut feel is that there should be a lot better cooperation. Certainly the pressures, you know, I always, from an investment point of view, try to think about the upside, not the downside. I mean, I think my statistics correct, but in the next, I think it's 30 years, the population of Africa will go from 750 million to 1.5 billion. I saw the statistic just a couple of weeks ago. It actually shocked me. So the pressures on food is not going to get better, but there's no reason that Africa can't harvest some of the natural resources that they have. They just have to use it better. My gut feel is they could be in a much better position than, you know, a place like Japan, for that matter. You know, even Europe has been exposed for, you know, some of the, as we call it, a weak underbelly. When it comes to energy, it's very difficult for Europe to do the right thing from a moral point of view, to try and go for renewable energy, but then have this reality where effectively the industrial capacity of their biggest economy almost got paralyzed overnight with one action from one person in Russia.
Hannah, do you want to add?
No, I'm happy to leave to the experts.
I mean, look, Jacques, there are a couple of things that we can do both domestically and regionally. Many of countries in Africa have the same problem as Mauritius, that a high dependence on food and energy. We import a lot. I think in the case of Mauritius, it's over 75%. So we need to shift, you know, from import substitution mentality to a food security and energy security approach. And that's extremely important. Now, that will depend to a large extent on what utilization you make of your land. I always tell people, you know, the first lesson I learned in economics is when resources are scarce, you must make the optimal use of these resources. Now, of course, everybody will try to get access to these resources, but as a country, we need to increase food security in our country, and we need to decrease our dependence on imported fuel. And there are two ways of doing this. One is to do some effective demand management, you know, on a personal level, on a corporate level, at a country level. And second is to embrace basically renewable energy as fast as possible. And on a regional basis, and look, I do some work in Africa. I think regional supply chain makes sense. One of the challenges you face in Africa, and beside the big four, or the big five, if you include Kenya, most of the countries are too small to have economies of scale, to have economies of scope, and economies of size. But if you think regionally, I think it makes sense. Basically, you to have this regional cooperation and to invest in A, B, C, D, especially in food security, and Mauritius could be part of that process. For instance, we can use our financial services platform to raise funds that could be utilized, in the context of food security and energy security, on the continent. Thank you.
Thank you, Kim. Some great macro questions. Maybe just to bring one question back to more of the stock selection, stock picking side of things. I think what was very clear was that you can't buy the index anymore. You've got a huge divergence in stocks outperforming and underperforming. So you've given us some great insight there on your presentation. Not financial advice, nobody can sue Hannah. Maybe give us one idea of something exciting that you think would be one of our favorite stocks to look at in the future.
So I did actually highlight it in our presentation on the, I think it was the third to last slide, where we had the example of high quality companies and the valuation levels they were coming from. There were three companies on that slide. There was Intuitive Surgical, IDEX Laboratories in the animal healthcare, and there's another one called Edwards Life Sciences. They're a company that are a leader in transcatheter aortic valve replacement, so that's heart valve replacement. And so instead of going into the hospital and having your chest cracked open and being a very invasive procedure, risky procedure, very long term, stay in hospital, which is expensive, of course, for the healthcare provider, for the insurance and so forth. They use a catheter up through through a vein in your leg or your arm, and they go in and they replace the valve that way. And they are pioneers, leaders in that. And they were a company that were exceptionally expensive because they're growing very fast. Double-digit earnings growth over the past decade. We believe that they can continue to grow very sustainably over the long term because there's a very large addressable market for that company. And they were trading around about a 1.5% free cash yield at the peak of the pandemic. They're exceptionally expensive, but they've halved this year. And they were actually, that chart that we had towards the end of my presentation where we had the three price earnings ratios, they very recently had a small profit warning which prompted a very large overreaction by the market, and so we actually just purchased that position in our portfolio. Like I said, it's an exceptionally high company, net cash on the balance sheet, very good operating margins. We're really excited to own that now.
Thank you. Yeah, fantastic. I think it's really time for high alpha investment. It's not really the market where you can buy the index and the tide carrier. You know what they say, when the tide comes out, that's when you see who's not wearing their shorts. Guys, so we've run slightly over on time.